makers and market movers. This is The Pulse.
Monday the 27th. Good morning. Welcome to The Pulse. I'm Guy Johnson in London. Let's talk about your top stories this morning. Oil under pressure as the US and Iran pause attacks for a second straight day. This after, of course, 2 weeks of strikes. Big tech firmly in focus with four of the Magnificent Seven set to report results this week after a sell-off sparked by AI spending concerns. And the British drug maker AstraZeneca reports higher than expected profits buoyed by a blockbuster set of cancer medicines. Let's take a quick look at what we are seeing when it comes to the cross-asset picture this morning. S&P futures positive, NASDAQ futures even more positive. The US 10-year 4.64. We've been at 4.7. Are we tracking to 5? Big week. Fed coming up. Euro dollar certainly benefiting from the lower energy prices this morning. 1.13. Let's call it 1.4 this morning. And as you can see, that lower energy price basically gives us a price of Brent at 91.09. We're down by circa 6%. Gas prices in Europe are down even more. Let's take a quick look at what we are seeing in terms of the equity market picture across Europe. Generally positive. Germany is outperforming, and that is certainly the picture that you can see with a bright green patch coming out of Germany. And that is actually where we are going to start our attention this morning, because the EFO survey is hitting the screens right now. We've also got commentary coming through from the ECB as well, pointing to rate hikes, further rate hikes still to come. But let me give you the headlines when it comes to what we are seeing with the July EFO expectation index and the business confidence index. The headline business confidence index comes through at 86.6. That is above estimates, which were at 86. So we are certainly seeing a better print there. The expectations index rises to 86.7. The estimate there was 84.8. So Germany's feeling better about itself. And the current assessment index, 86.5. The estimate there, 87.3. So near term, things are looking tough. The kind of the outlook, though, starts to improve. Net, a slightly better than anticipated number. Clemens Fuest is the president of the EFO Institute and joins us now. Did I get the read right? Is that the picture we're looking at right now for the German economy?
I think it is. So current business is difficult. The situation is volatile. The situation in Iran, we don't know where it's going. But expectations for the coming months are improving, and this is coming from manufacturing, among other sectors. But manufacturing is exposed to these problems, to the geopolitical tensions, and nevertheless, companies are saying they do expect an improvement in the next half of the year.
Clemens, how much of this relates to energy? This looks like a fairly good number. The outlook number is improving. The current number is tricky. But we're seeing a lot of energy volatility at the moment. How is that impacting the numbers? Is this just a reflection of the energy outlook? Germany is obviously heavily energy intensive.
We do see the impact. If you look at the reading for the chemical industry in particular, it's bad. So the chemical industry is really affected. It's by far the most energy intensive sector. But in German manufacturing, there are sectors, and quite a lot of sectors, in fact, that are less energy intensive. And they seem to be less affected by this. Of course, they're indirectly affected through consumer confidence. At the same time, we see that incoming orders are improving, and it's not just domestic orders, it's export orders also. So the environment seems to be improving slightly, of course, starting from a very low level.
Clemens, the Chancellor, Friedrich Merz, promised a year of growth. Does this feel like a year of growth to you?
Well, we did expect, at the beginning of the year, we did expect a recovery. It's not a very dynamic recovery, but a slow recovery, and that was interrupted by the Iran war. And now the expectation is, yes, maybe the second year, if nothing unexpected happened, the second year may be one of growth, of recovery, but it's going very slow. It's still mostly driven by government demand. We see it in construction, building of roads, and similar things, train tracks. This is a sector where companies are saying, yes, we have incoming orders. It's working quite well. And that's driven by this debt-financed fiscal package. It is growth, but the growth will be weak, certainly below 1%.
But looking at the expectations index, should I assume that the second half is going to be better than the first?
It probably will. Companies have become more optimistic, and there are also some current numbers underpinning this. There is a slight increase in incoming orders, not just domestically, but also international orders. So the German manufacturing has been struggling regarding competitiveness, is under pressure by Chinese competition. But it seems that there is some consolidation now, and companies have adjusted, so they are more confident regarding the second half of the year.
We're just getting some comments coming through. Casimir, I think, is the latest member of the Governing Council to make comments relating to the outlook for rates. The view there is the ECB will need to raise rates at least once more. Clemens, do you think the German economy needs rate hikes right now?
Germany is in this situation now where the growth is almost weakest in the Eurozone, but the ECB obviously looks at the Eurozone as a whole, and there are price pressures, and it looks like with the current conflict in the Persian Gulf, it looks like these price pressures are not going away. So there will be increasing pressure on the ECB, and I think for the Eurozone, a rate hike will be the right move. For the German economy in particular, it is more problematic. But as I said, the ECB has to look at the Eurozone as a whole.
OK, but what impact do you think those rate hikes are going to have on the German economy? You call it problematic. If we see one more, two more rate hikes coming through, two more maybe a stretch, but what impact do you think a higher cost of money is going to have right now?
Yeah, it's going to affect construction. In particular, construction of apartment and housing, it has been weak for some time, and this won't make it better. So this part of the economy will remain weak. We have a lot of spare capacity in manufacturing. So in that regard, a rate hike isn't appropriate, especially for the German economy, and it will maintain pressure, and it will have the effect that overall growth will remain subdued. So the German economy could certainly live without a rate hike and live better without a rate hike. But given price pressures, given that inflation is above the target, I think the ECB has very good reasons to hike at least once this year.
I was talking to a CEO of a large chemical company, coating company, AkzoNobel, a few days ago, just talking to me about the belief that he has that basically we're dealing with permanently higher energy costs in Europe. Just looking ahead, further down the road, Clemens, how adaptable do you think the current German economy setup is to higher energy costs that are permanently embedded? Can Germany be competitive at these kinds of rates?
Well, I think it can, but at a lower level. We have already lost almost 20% of production, for instance, in the chemical industry. So to some extent, this adjustment has already taken place. The energy-intensive chemical industry, which is staying in Germany, has to have other comparative advantages. Otherwise, it wouldn't be able to stay. I think for the future, this means that the energy-intensive industry, the energy-intensive sectors will not be the ones driving growth in Germany. That has to come from other sectors. Automotive will not be driving growth either. So it will have to come from sectors like health, from sectors maybe more service-oriented sectors, from certain less energy-intensive manufacturing sectors like building of machinery, optical equipment, electric equipment. So it will have to come from other sectors. So what's required in Germany is really structural change.
Yeah. What about defense? How big a driver do you think that's going to be?
Yeah, defense is part of this. Defense is the one sector where we do have a booming economy. We have successful startups, but also the established defense companies are expanding. The trouble is that the size, if you look at the size of the defense industry, it is small compared to the big sectors, to automotive and machinery. So it will take time before this will have a strong impact on the economy as a whole. But we do see some conversion. There are discussions at Volkswagen of converting factories to produce defense goods. So this transition is going on, but defense is too small to save the German economy.
Clemens, always a great pleasure to catch up. Thank you for bringing us instant reaction to the data that you just delivered us. Clemens Fuest, the president of the IFO Economic Institute. Coming up, we'll go back to that energy story. Paul's dropping this morning. Bonds are certainly moving as a result of that. We're going to bring you the latest market reaction as the US pauses strikes on Iran. We'll do that next. This is Bloomberg. Good morning, 30 minutes past the hour. Welcome back. You are watching The Pulse. Let's talk about what we're seeing in terms of the energy markets this morning. Oil and gas prices sharply lower, with the United States and Iran holding fire after weeks of escalating tensions. The New York Times, though, has reported that President Trump held off on plans to escalate the conflict over the weekend, in part because of concerns around the fact that we could see the war draining supplies of US air defense weapons, interceptors. But speaking to NBC's Meet the Press, the US ambassador to the UN, Mike Waltz, pushed back on that idea.
I want to be crystal clear. The U.S. military, and I've verified this every which way, has everything that it needs to conduct this campaign as effectively as it needs to be. And I have to tell you, the people that are leaking this nonsense deserve to be in jail.
For more, Bloomberg Horizon's Middle East and Africa anchor Abir Abu Omar joining us now from Dubai. The markets certainly, Abir, if I look at the market reaction this morning, big drop in energy costs. Anything that signals that maybe we're going to get de-escalation enough to provide this. But how much de-escalation are we actually seeing here?
Good morning, Guy. Well, remember when the market did this the first time around, right? We saw Brent prices at around 120, 125, de-escalating to around $80 on the barrel. And then we saw this escalation over the past 13 days and then signs of de-escalation over the weekend. So in a nutshell, what happened was the U.S. over on Friday ended 13 consecutive nights of strikes against Iran. Now, this is important because we don't know why that is. Now, as you have mentioned in your intro, Guy, the New York Times has reported that this could be due to the U.S. running out of munition. And then Mike Waltz said that that is not true. President Trump, cited by the Wall Street Journal, also saying that the U.S. has more than plenty munition. Iran, over on Sunday, the army said that it will suspend attacks on the region and shipping in the Strait of Hormuz as a result of the U.S. halting its strikes there. We know that a delegation, an Iranian delegation, visited Oman over the weekend, where they both sides had discussed the movement in the Strait of Hormuz. We don't have a lot of clarity on what is happening there, what those discussions entailed. For the time being, the traffic in the Strait of Hormuz is still pretty much paralyzed. We have a parallel war that is happening between Saudi Arabia and the Houthis in Yemen, and that is also having a risk on traffic at the Red Sea, where Saudi Arabia has managed to move most of its crude since the beginning of the war. We continue to monitor the discussions and whether they're going to happen. But, Guy, just one other thing that is incredibly important, and that is the deadline, August 16th, for the MOU, or the temporary ceasefire that was reached in June in Switzerland between Iran and the United States. That is coming very, very close. And we're not seeing any discussions happen over the 14 concessions that were part of that temporary ceasefire agreement. So something to keep an eye on. For the time being, the Strait of Hormuz is front and center in those discussions.
A bit. Just back up a little bit. I just want to talk more about what we are seeing with these talks that are taking place between Iran and Oman. What are they talking about there? Is it just the Strait, or do they go further?
Yeah, that's a good question. And again, we don't have a readout of what exactly was discussed between the two. We know that the deputy foreign ministers of both countries have met over the weekend. The Iranian delegation left back on Saturday. A slight sort of hint of what was discussed was just the Strait of Hormuz and Iran's assertion of dominance over the waterway. Now, we've spoken in the past, Guy, about both countries having some kind of mechanism to take control over the waterway in the period after the temporary ceasefires over. We know that Iran is still very adamant on applying that mechanism where it also charges fees to ships that are moving through the Strait of Hormuz. For the time being, there's no reason for us to believe that it wants to do anything different. And just something else to bear in mind is that while the United States has halted its attacks over Iran over the weekend or over on Friday, it still maintains its naval blockade and threatening ships that are daring to cross pathways that it has not laid out. Iran doing pretty much the same thing. So what we know out of that meeting for the time being and so far is that they just discussed the Strait of Hormuz and the shipments that are going through Iran in the aftermath of that meeting, saying that traffic continues to be paralyzed in the waterway.
Okay, Abir, thanks for the update. Greatly appreciate it. Abir Omar joining us out of Dubai. Subitha Subramaniam, Chief Economist at Sarasin and Partners, joining me around the table. Good morning.
Good morning.
What do I do with this kind of volatility? If you're an economist and you look at this, you're getting huge amounts of energy volatility. Consumers traditionally don't like, if you look at behavioral economics, don't like kind of volatility, but we're getting it on almost daily basis. Like almost got a sort of 7, 8, 9% swing in gas prices today. How does the European economy deal with that kind of volatility? If you're trying to manage the European economy, invest in the European economy, how do you deal with this kind of volatility?
I think if it was just volatility in prices, in energy prices, that's one shock. But I think the second volatility you're getting is in rates as well. And actually it's translating into actual investment decisions. So I think it's really difficult. I think at the end of the day, there's a volatility premium that gets baked into how people invest, how they consume. Volatility is a tax on growth. We shouldn't get away from that. And what we have seen is that as the volatility persists, we are getting sort of, as we see in Europe, the growth rates have really started to sort of come down as a result of all of this. So I think that's what the long-run implications of volatility will be.
Is this something we're just going to have to get used to? Is this something you talk about baking it in? That implies some sort of degree of permanence.
Yeah, and I think, I think this is here to stay. I think the world that we are entering into is much more fragmented in terms of just trade. I think if you look into the future, we're going to start seeing more capital flows becoming more fragmented. We're starting to see the early signs of capital starting to behave very differently depending on where you are. I think today bond markets behave in a very synchronized fashion. They're all linked to U.S. Treasuries. But I think we're starting to see sort of markets starting to pull away. In the UK, the gilt market was very closely linked to U.S. Treasuries, and we're now starting to see a different premium in gilts. We're starting to see the long end of the Japanese bond market reflect Japanese political pressures. So I think capital will also start to fragment. And so this level of volatility and more country risk premium will start to build. OK, so you bring up U.S. Treasuries. So let's talk about U.S. Treasuries. Okay. The Fed this week. What do you... around a third chance of a rate hike this week. Do you think that's under or over? I think it's overestimating it. Kevin Walsh has come out and said that he's not going to put a dot. So he really does not want to sort of show his hand. He's put out 5 task forces. And I think before we get the results of those task forces, some of which will be sort of presented at the Jackson Hole in August, before we get that, I do not believe that the Fed's actually going to sort of materially change its stance. I would say that at this FOMC, we will get a couple dissents, most likely. Lori Logan, the Federal Reserve President of Dallas, and Beth Hammock from Cleveland, they are both likely and have indicated that they would like to move preemptively against inflation. If we don't, given all of that, looking ahead to the next meeting, like the market's pricing just shy of 70%, does that sound about right? I think that's a little bit overestimating what the Fed is likely to do. There are 2 things to remember. The Fed says that the neutral rate for the U.S. is 3%. Interest rates today are somewhere around 3.65. So the Fed is actually plausibly saying, well, we're really restrictive already, even before we've got a supply shock coming through and being reflected in prices. So they're plausibly restrictive. Now, the real point is that actually these neutral rates are quite stale. I think we see this whole capex boom build out within the US, and actually growth and nominal growth is really very, very strong. So it is likely that the Fed is actually sort of optimizing to the wrong neutral levels. And so it's going to say, like, we're plausibly restricted, restrictive. We look through this supply shock and everything will be fine.
Yeah, OK. Plausibly restrictive. This doesn't look like an economy that is being restricted at the moment.
No, and I think, again, I just sort of, say something what Powell said. We'll know policy when it's restrictive based on what the economy is doing. Yeah. So in all honesty, I mean, the U.S. economy is growing at a nominal basis, at least at 5%. This is a very strong economy. We have CapEx building through. There is no sign of any sort of, abatement in the CapEx intensity of the economy, and it's going to only sort of increase further over the next coming years. So I think this is not an economy, as you look at it, that feels quite restricted in monetary policy and fiscal policy.
Bank of England?
Bank of England, to be honest, is actually quite restrictive. You can, as we've talked about, this volatility, sort of, ever since Brexit, we've had a higher risk premium across the economy, and actually, the underlying growth rates are lower in the UK, and so rates where they are slightly restrictive. And, investment is quite weak. Consumer spending is, not that great. So the only lever of growth is the government spending, which looks like, we're going to get a bit more of an impulse from that.
It's interesting, actually. Burnham this morning is talking about the fact that he needs to cut spending. He needs to tackle the welfare bill. You smile. Like, how realistic do you think this actually is? Is he saying the right things, but will he do the right things?
I think his policy sort of framework is, is being put together as we speak. I would expect that, yes, he understands that he needs to cut welfare spending, but that's only because he realizes that his degrees of freedom are materially curtailed by the bond market. I think we're all sort of slightly missing the point here. Everyone's incessantly focused on the budget constraints today. Are we within the fiscal rules? The reality is that if we don't have a growth model, we will not be within the fiscal rules next year and the year after. So it really is like, what is his vision for growth in the UK? And I think here, I don't necessarily, as of yet, see much of a credible plan. I think devolution, great. Maybe, in a few years' time, we'll get a bit more growth and efficiency from the economy. And beyond that, cutting VAT on electricity. These are all very small, sort of, I think, tinkering around the edges, addressing a cost of living issue, which is really being driven by things outside his control. It's energy prices, it's interest rates, none of which he has much control over. So it's really, what is his vision for this economy where government spending is 45% of GDP today? Are we going to get to, with more government, get to 50% of GDP?
We're already 5% above where we were pre-pandemic.
Exactly. So we're 5%. So the government's footprint in the economy has grown much larger. We're very dissatisfied with what the outcomes are. We are not growing. So I don't understand how we make this economy more dynamic without embracing more market-based measures to incentivize
But he doesn't like
growth.
Thatcher and he doesn't like neoliberalism. So there's, I don't know what the new model looks like.
Exactly. And I think this is really the question. We have a 10-year growth plan that he's going to come out with, a vision for growth. Let's see whether he embraces the market.
Do you think the bank just sits there and waits for all of this?
I think every central bank in the world is just hoping to just sit there and wait for the supply shock to subside. The reality is they can't control supply shocks, and they don't really... so it's a question of, are you plausibly restrictive? And I would say here the ECB has actually been more on the front foot. It's gone ahead. It's saying that our neutral rates are actually slightly higher as a result of what's happening in the world, and we will, adjust as things have evolved.
Subitha, nice to see you. Thank you very much indeed for coming to see us. Subitha Subramaniam, Chief Economist at Sarasin and Partners. What are we going to do next? AstraZeneca out with numbers this morning. We'll talk and figure out exactly what is happening here. So a couple of things you need to know. Profit has beaten quite significantly. They've done really well in oncology. We had the CFO on Bloomberg Air a little bit earlier on, and she was painting a really positive picture, not just up to 2030, but beyond that. And the market seems to be responding fairly positively to that this morning, and that stock is having a positive impact on the FTSE 100. This is what European markets look like this morning, responding positively as well to the energy price story that we are seeing. Energy prices are lower. Look at the German market responding to that. very strong performance coming through. Elsewhere, an underperformance maybe coming through from the FTSE. The reason for that, the energy stocks, though there are other stocks, and Astra's one of them that we're watching quite carefully. The CAC 40's quite interesting. The key number for the CAC 40 in some ways comes out a little bit later on today. LVMH will be out with numbers after the bell today, and we're going to watch those numbers very, very carefully. Anyway, we'll get back to AstraZeneca in just a moment. That's the European picture as we see it. This is Bloomberg. Welcome back. Let's talk about what is going on. The Chinese chip maker CXMT surging on its trading debut. We will talk about that in just a moment. In terms of the kind of main headlines that we're talking about this morning, there's a bunch of things you need to know. Oil is down. The reason for that, Iran and the US are pausing their attacks. You've got a tech story which you're watching very carefully. You've seen, as I just mentioned, a big IPO out in China, but you've got 4 of the 7 Mag 7 reporting this week. Keep an eye on that. You're also getting a lot of volatility around the energy, around the memory story, so we're watching that quite carefully as well. And we are continuing as well to watch the economic data come through, and we're watching that very carefully. There's some single stock stories that are definitely worth paying attention to. The British drug maker AstraZeneca reporting higher than expected profits, very much buoyed by its blockbuster cancer medicines, but it's looking ahead. Right, let's get back to where I was just a moment ago, and that is talking about what we're seeing in terms of the Chinese chip story. The Chinese chip maker CXMT surging on its trading debut overnight, this after a $9.8 billion IPO. Investors flocking to the stock ahead of a week of tech earnings, which will certainly test the AI trades. Anthony Stevens joins us now to talk about this. CXMT, not exactly priced for perfection, a big pop. I'm assuming that this is a mispricing by design.
Yeah, it is, right? The whole point of this AI boom in China, as far as the IPO market is concerned, is to further fund China's AI expansion. So these trades are being priced really well for retail to make money. This continues a pattern of AI trades doing really well in the Chinese market that goes back a couple of years now. And most of those results, those IPOs have been up around 100% or more. This includes other chip makers, memory device makers, and just generally silicon players in general. This sets the kind of tone for the IPOs to come, which include YMTC, which is one of CXMT's competition, Baidu's AI chip makers as well. So the whole tone of this industry now is to list and to get these big gains.
Okay, let's talk about what is happening stateside. A piece that I think caught everybody's attention in the Journal this morning, talking about what is going on with Nvidia and OpenAI and how Nvidia is going to help OpenAI lease a $500 billion data center. Circularity is the story here.
Yeah, look, there are 2 ways of looking at this. One is a financial engineering where you have the suppliers of the AI chip trade really cashed up. They have money to deploy, and they are going to deploy that, helping their customers gain these data centers, put these data centers into place so that their demand for chips and chip materials can continue to grow. So that's kind of the bullish case. The cynical case is that this is a replacement for bond financing, where credit spreads and CDS are starting to move away from the hyperscalers and kind of crimp their fundraising abilities. So you'd have this kind of a debate in markets whether the circular financing is a legitimate use of these massive cash balances from chip makers, or an attempt to move some of this debt off balance sheet away from the bond market scrutiny and any kind of evaluation of the sustainability of this cash flow. Now, how that debate gets resolved is in the public markets by looking at CDS of the names that are listed on the CDS market. You're going to get a huge update on the sustainability of this capex in the earnings season that we're approaching.
Okay, 4 out of the 7 are reporting this week. Mag 7, I'm talking here. What am I watching for? Give us the kind of the skinny on what are going to be the key things that the market focuses on.
Yeah, it's an extraordinary week for earnings season, given the fact that it's top to bottom of the AI trade. So you do have the 4 out of 7 on the Mag 7, as you said, but you also have a lot of suppliers in the US and in Asia. So you have Teradyne, you have Qualcomm, you have Seagate in the US, and in Asia you have Kioxia, you have Samsung, you have Hynix. Now those latter 3 names are pretty much, the determinant of the future of the memory trade. For example, in Teradyne and in Seagate, you have the testing and the hard disk space, and in the Mag 7 you have the demand for all of the above. And how aggressive is this capex going to be from the hyperscaler side, but also how aggressive is the capex going to be from the semiconductor manufacturing side? So how quickly is supply going to come in on all these chips to meet this hyperscaler demand? So you're getting a huge update in summer on the future of the trade. Now, this trade has come off so sharply in July that everyone is going to be watching. It's no longer the AI is up or AI is down market. We are entering July, at the end of July, into an extremely dispersed tech trade, and people are going to be paying very close attention to the small details in these results.
Yep. Winners and losers. Anthony, thank you very much indeed. Anthony Stevens on what we're seeing in terms of the tech trade. Let's go from technology to pharmaceuticals. AstraZeneca has reported higher than expected quarterly profits buoyed by its cancer medicines. The drug maker also released promising results for an experimental treatment for gastric cancers. But disappointment for a medicine to treat a rare blood disorder is also a factor here. Astra's CFO was on our air a little bit earlier on, telling us she's confident the company will meet its big sales goal.
When we had given that number for 80 billion, it was a stretch target. It still is a stretch target. At that time, consensus was at 67 billion for 2030.
Yep.
Now consensus is ahead of 80 billion. They were almost close to 81, 82 billion. So I think as time has gone on and we have de-risked more and more studies, people are getting comfortable that we will achieve the 80 billion.
Right, Sarasin, the CFO of AstraZeneca. Let's bring into the conversation Bloomberg's EMEA Healthcare and Consumer Team Leader, Deirdre Hipwell. These are strong numbers. The market generally appears to like it. They haven't raised the 80 billion target, which some would like to see, nevertheless. But is it beyond oncology? Is it beyond cancer? This is a company that is very strong in that space, but is there more to it than that?
Absolutely, they are very strong, and I think what we've seen today is they've slightly reassured the market, because obviously a few weeks ago they had a disappointment with a heart drug, which was rare for Astra, and the share reaction was quite marked. So I think today they've shown that they still have growth in their oncology pipeline, and that 80 billion revenue target by 2030 is looking increasingly easy for them to meet. The key will be obviously the focus on what comes after 2030, but we heard from the CFO, she's confident that they can achieve that. So
what are we looking for? Where should we be focusing our attention in terms of what the pipeline needs to deliver?
Well, oncology is obviously still a key focus, and they have some key readouts coming in, a lung cancer drug and a breast cancer drug later this year. But they are also developing a number of obesity assets, and as we know, that is a huge hot area in pharma right now. So they are hopeful that some of their assets will find a niche post-2030. And you remember, AstraZeneca has a very strong cardiovascular section, so they see some potential for combining some of their obesity assets with some of their cardiovascular treatments. So even though they're quite behind the market in terms of where Novo and Lilly are, they still think there's growth to come there.
OK, great stuff. Certainly the market taking it reasonably well this morning. Reassured, maybe, is the way to look at this. Deirdre Hipwell, thank you very much indeed. Let's continue with the earnings story, but widen the lens a little bit. Big week ahead for Europe. The results are expected from, we've got a whole load of major banks coming through. You've got car makers, you've got some aerospace companies coming through, airlines, defence firms. It's all out there. Let's talk about what we've learned thus far and therefore what the context is going into this week. Tim Craighead, Global Chief Content Officer at Bloomberg Intelligence, joins us now. So far, so good? What does the picture look? We're about a third through, aren't we?
Yeah, we're about a third through. Interesting to think about this coming week. We've got a whole another third coming just in the next, 4.5 days. But so far, 50% beat, 30% miss. If I look at what our equity strategy team, that just published a note on the terminal this morning, have come up with, running about 12% in terms of earnings growth, which is slightly better than what was expected. But it is narrow. Pharma, financials, and semi-equipment, specifically ASML, have driven the lion's share of the growth. And some of those areas where there's been high expectation, electrification, energy transition, things along those lines, have failed to quite live up to expectations. So some of the industrial and energy companies.
Okay, so that takes me on to kind of how has the market been reacting? I've seen some, on a daily basis, I'm getting some quite big moves either way.
It is amazing. And you think, year to date, we've had about a 10% positive revision to 2026 earnings for Europe. A big positive revision. So the bar is quite high going into earnings season. And thus far, if you beat sales or earnings, you've got a modest bump, 1% or so. It's a take no prisoner market, though, on the misses. You're down 3% or so if you miss on the top line, bottom line, or both. So, it's definitely skewed towards the negative.
Towards the negative. So that's where the skew. What is interesting is you talk about that kind of earnings, kind of the earnings outlook. The earnings outlook is incredibly positive at the moment. You look at the numbers and you have to sort of double check that actually you're looking at the right kinds of figures. What are the investor calls? What are the outlook statements telling us at the moment? And do they marry with those very high expectations that analysts are delivering?
I tell you, you think markets are at record levels. We've gone through tariffs. Now we have tariffs again. We have a Middle East crisis that won't quit, and yet stocks are at record levels. Managements quite often are trying to be cautiously optimistic, but still throw out some concerns. In the earnings calls thus far, however, our equity strategy team has a really interesting data science-driven sentiment index that they track. Record levels, highest since we've been out of the pandemic. Very positive on AI implementation, efficiencies, productivity, even revenue opportunities. They're not mentioning the supply chains proactively, but when asked, they do highlight that they're there, but they don't seem to be overly concerned. So it's been really interesting with positive skews on these calls.
Tim, thanks for the update. We'll continue to watch what we are seeing here and your analysis of it. Tim Craighead from Bloomberg Intelligence. Thank you very much indeed. Let's talk about some of the other stories we're watching this Monday morning. The US has said that the US is said to be pressing Mexico to bring its tariffs on Chinese steel and aluminium in line with Washington's tougher measures. While it represents a big ask from US trade officials, Bloomberg understands that Mexico is receptive the proposal being discussed as part of the broader USMCA negotiations. Details, including tariff rates and the affected products, are under review with the aim of reaching an agreement, we think now, by the end of the year. And the UK Prime Minister Andy Burnham will host the Ukrainian President Volodymyr Zelensky as his first international visitor. Their meeting at a naval base is a sign of Britain's continued support for Ukraine and will allow UK officials to help Zelensky prepare for his meeting with the US President Donald Trump, which is now scheduled for later on this week. And the other story, of course, that we are watching so carefully this week, after this weekend, more than 300,000 people have fled their homes in France and Spain as wildfires threaten major cities of Madrid, Bordeaux, as new blazes erupt in eastern Spain as well. Let's bring in Bloomberg's Caroline Conan for an update. What does it look like this Monday morning, Caroline? The pictures over the weekend were harrowing.
Of course, on Friday, you had people flying by boat from the Cap Ferret Peninsula towards the Bassin d'Arcachon because the only road there was very congested, with the firefighters trying to contain this massive wildfire that at the moment has burnt about 42,000 hectares in the southwest of France, in the Gironde region. That's about 4 times the size of central Paris. To give you an idea, in Spain, it's about 50,000 hectares outside of Madrid that have burned so far. It seems like in both places, however, the past few hours have been a little bit better. The conditions have been a bit more favorable. In Spain, they're saying that the evolution of the fire is positive but slow. In France, we expect some temperatures dropping and some light rain today. However, the window is going to be very, very tight. Today is going to be very decisive in France because the fire is not contained yet. It's still progressing towards Bordeaux, towards the metropolis that has 265,000 inhabitants. And the problem is that as soon as tomorrow, we expect the temperatures rising again and another heat wave coming in France over the next few days. So there are only a few hours left in order to try and contain this massive fire. Thousands, of course, of firefighters are struggling by air, by road to contain this fire. More than 200,000 people have been evacuated across the region because if you look at Lège Cap Ferret, for example, this very wealthy tourist destination, it has 8,000 inhabitants during the winter, but more than 100,000 tourists during summer. So a lot of these people have already been evacuated. At the moment, the airport of Bordeaux is still operating, but all the trains south of Bordeaux have been cancelled so far. We don't exactly know when they will be able to run again. The spokeswoman of the French government just a few minutes ago was trying to reassure, saying the evacuation of Bordeaux, of this metropolis, is not on the table quite yet. But last night we had the Interior Minister on TV who didn't rule it out.
OK, so what do we expect to come out? Is it started already, this emergency cabinet meeting?
It has started in about the past 40 minutes or so, and we actually do expect a statement from the government, from the Élysée Palace, in the next few minutes. So we'll see exactly what comes out of this. At the moment, we heard from the Finance Minister, Roland Lescure, earlier this morning. He was saying that the insurance companies, the insurers will take up to 3 weeks of cost of relocating all these people who had to be evacuated from all these villages around Bordeaux and around the Bassin d'Arcachon. Of course, the cost for these insurance companies will be huge. That's one of the questions we'll be asking the AXA CEO, who's coming on Bloomberg TV exclusively this Friday morning for earnings. The French government, of course, has been a debate as well about the use of the Airbus A400M, this this military transport plane that can be converted into a water tanker and, of course, be much bigger than the current small Canadair water tankers that are being used across the region. It took actually days since the fire started last Wednesday in the region to deploy this A400M. And there was a lot of political reactions with Jean-Luc Mélenchon from the far left, Jordan Bardella from the far right, calling for the government to hurry and deploy this plane that was still being tested in order to be used and converted into a water tanker. So, of course, there will be a lot of discussions after this, political debates about how much it costs and what are the political consequences of these massive wildfires.
Yep, it's a big plane, probably quite useful. Caroline, we're going to continue to monitor the situation very, very carefully. As you say, we're going to watch the outcome from this cabinet meeting and also what is happening on the ground. Bloomberg's Caroline Canan joining us from Paris. Coming up, we're going to talk the M&A story. M&A activity in Europe picking up. We're going to discuss what comes next. We'll do that after this short break. This is Bloomberg. Tim is at the top of the hour. Welcome back. Let's talk about the M&A story. Dealmakers are on course to potentially pass the record M&A haul that they achieved back in 2021. Transaction values are up around 30% year on year to $2.6 trillion between January and June, that is. My next guest is from a law firm which was top of the Bloomberg rankings for 2025 deal volumes. Inenacho is a partner at Latham & Watkins. Good morning.
Good morning, Guy. Thanks for having me.
Good year so far?
A really good year. Yeah, it's as you said, volumes of M&A transactions are down about 9% globally, which is a record low. more pronounced in Europe, down by about 14%. But what we've seen is an incredible increase in value. So $2.6 trillion of M&A value in the first half of the year, which, as you say, is over 30% up. Yep. And I think the story of the first half of the year, and I think we'll see that continue into the second half, is this rise of the mega deal, these very significant strategic transactions that are being executed in what some commentators are calling a conviction cycle rather than a volume cycle. And I think we're going to continue to see that as the year progresses across a number of industries.
So why is that happening? Why are we not getting the bigger deal? Why are we getting the bigger deals but not the deals further down? Why are total volumes not up?
Yeah, very good question. So, look, I think when you look at the market, I think boards are realizing that the amount of management time and focus that it takes to do a $1 billion deal or a $2 billion deal is more or less the same as doing a $10 or $15 billion deal.
Right.
But when you look at the performance of those larger deals, there's a good argument that they have performed better in terms of realizing synergies, in terms of realizing better re-ratings of the combined businesses, and in terms of strategic alignment. So there's an argument that they perform better, you're spending the same amount of time on them. And so I think what boards and investors are seeing is that where they see these transformational opportunities, they're moving really decisively to capture them rather than spending their time on smaller transactions. And they're doing that in an environment from a financial and a regulatory perspective that's conducive to deal making. So if you look at financing, we're obviously not at interest rates around 2019, 2020 rates, but rates have come down. So when you combine that financing capability with the trillions of dollars of dry powder that private equity funds have available to invest and the trillions of dollars of cash reserves that corporates have, it's a really good environment to do these and finance these big acquisitions. And from a regulatory perspective, I think what we're seeing is that regulators have been more receptive to remedies, so structural remedies like divestitures, behavioural remedies, as opposed to blocking deals outright.
I think Europe's becoming more open. For the last kind of 20 decades covering this, Europe has pushed back. Don't like big deals, don't like sort of quasi-monopolies, don't like sort of giants, want competition, push back hard. Do you think that... Do you think post-Draghi that mentality is beginning to shift a little bit?
I think the narrative is changing a bit. I think it's all part of this story around economic security and national security. So if you look at what governments are doing across the continent, they're looking to protect domestic supply chains. They're looking to build national champions, whether that's in defence, whether that's in healthcare. And I think some of those priorities are overriding, perhaps, some of the priorities of the past.
Okay.
So the market is opening up. The regulatory environment, buyers are feeling more confident that they can navigate these complex deals through the regulators.
OK. You talked about private equity just a moment ago.
Yep.
Private equity's got some tough vintages for a few years back that it needs to figure out what it's going to do with. You guys are big in private credit, you're big in restructuring, you're big in private equity as well. There's a lot of secondaries happening at the moment, and the market is really struggling to value assets. I'm a seller, I want X. If I'm a buyer, I want X minus Y. And that gap is massive still. Any sense that that's closing? Any sense that you are going to see more deals coming down the road? What would be the catalyst for bringing those two sides together?
Yeah, it's a very good point. Look, secondaries has always been part of the ecosystem of private equity, but it's a much bigger part. There's about $118 billion worth of secondaries in the first half of the year, which is a record surpassed last year. There is estimated to be 30,000 unsold portfolio companies in private equity, and quite a significant proportion of those have been held for more than 6 years, 7 years.
So they get pushed into continuation funds and all kinds of other things.
They're getting pushed. You've got to remember the life cycle of a PE fund is about 10 years, so they're colliding against that life cycle. So this market has developed as part of the ecosystem that enables investors to receive liquidity. It allows managers to hold on to the assets and unlock that value in the future. Buyers can invest in more mature, understandable businesses rather than new funds and new opportunities. So it is part of the ecosystem now, and I think we'll continue to see it being part of that ecosystem. But what we're also seeing, I think, and we'll continue to see into the second half, is buyers and sellers having the confidence to get around the table and be creative around how they bridge that gap. So whether it's through earn-outs, whether it's through sellers rolling a proportion of their value into the next deal to get the deal over the line. And we're also seeing private equity doing more than just buyouts. You know, they're investing minority stakes, they're doing structured equity. So the industry's pretty resilient, and it's finding ways of creating value for its investors.
Kem, great to see you. Thanks for stopping by to see us. We really appreciate it. Kem,
thanks very much.
Inenacho joining us from Latham and Watkins. Let's wrap things up. Quick look at what we're seeing in terms of the European picture this morning. You are certainly seeing a big reaction to what we're getting on the energy markets. Energy markets are down quite sharply. European gas is down very sharply today, but the Brent price is also very much softer. Look at the board in front of you, and it tells you kind of which part of the European economy is most energy dependent, and it is definitely Germany. Germany is reacting the most positively to all of this morning. The stock market there is up by 1.5%. Reasonably positive outlook from IFO as well coming through today. US futures are also very positive as well. We'll take a firm look at the tech space a little bit later on, but that's the picture you're looking at right now. So that wraps things up from Europe. I'm going to hand you over to the United States, and the brief is coming up next. This is Bloomberg.